It is time to be the CEO of my life.
In episode 4, Mrs. Erica described the wealth creation journey. She talked about managing active income wisely to save and invest in income-producing assets. She emphasized the reinvestment of passive income into more income-producing assets to accelerate the growth of passive income. This time, Mrs. Erica teaches Chris how to interpret market data that influences the value of common investment assets. She describes the investment monitoring process and uses stock investments to emphasize the analysis of asset valuation, cash flow, and risk.
Good morning, Mrs. Erica.
Good morning, Chris.
I shared your budget management tips with my parents. They realized they could have started building wealth through compound growth much earlier in life. They spent their first 10 years paying off student loans and could only afford to buy a house after 5 years of earning active income.
They probably put their money in an employer-sponsored 401k plan, managed by a third-party fund administrator.
I guess they never saw the need to invest in financial education and become more active investors.
Good point. I'd add some nuance. They may have chosen to trust their employer's plan. Active investing can be risky if you don't know what you're doing. That's actually the core of our topic today. I'll use stock investing to highlight the challenges, rewards, and risks of actively monitoring your investments. Before buying any asset, do your due diligence by analyzing the risks and tax implications so you can develop the right risk management strategy. The purchase price should never be your main focus. Once you understand the risks, the next step is to identify the key factors that could affect the asset's price. This process is called price discovery. The screen shows multiple factors that drive 8 core indicators, which you analyze against the asset's price by establishing cause and effect relationships. The market movers at the top represent different types of data, facts, and events that inform our understanding and perception of the financial markets. They reflect different types of market forces categorized using the labels industrial and business, consumer, monetary and financial, global, and event-driven. Ultimately, the market movers are converted into 8 core indicators that help explain what influences market behavior and asset price movements. These 8 core indicators characterize the business cycle: inflation, interest rates, employment, consumer spending, credit conditions, trade, and geopolitical factors. The assets that are commonly traded on financial exchanges cover stocks, bonds, real estate, commodities, cryptocurrencies, insurance, and speculative products. The power of active monitoring lies in connecting the dots, anticipating asset price movements, and figuring out when to trigger Plan B. That is the mindset of a good investor. Make decisions based on data, facts, and analysis, not fear or greed.
What about the ROI calculation?
I suggest that you divide the cash flow produced plus any capital gain by the purchase price combined with the cost of your Plan B, which could be a sale transaction.
That reminds me of the formula you suggested in episode 3 for calculating the risk-adjusted return on education.
Great observation! Monitoring means analyzing the core indicators regularly to predict the ROI by year-end. You assess the validity of the market data, the cumulative impact of market forces on the asset's price, the value at risk, the cash position, and the risk-adjusted ROI. You plan to protect your cash flow by triggering Plan B, or selling the asset to realize a capital gain. Be reasonable and start by investing in stocks that generate consistent cash flow through dividend payments. I suggest choosing an undervalued asset to maximize your potential capital gain. You may use it as collateral for borrowing. Let's illustrate these concepts with the example of a tariff war. How could tariffs affect the valuation of stocks? A tariff war is one type of event linked to the core indicator geopolitical risk, so pay attention to the last row in this table. A tariff war typically increases the cost of imported raw materials. Companies may then raise their prices to protect their profit margins. Consumers may respond by buying less, which may potentially reduce the company's profit and negatively impact the stock price. It's important to note that the CEO chose to pass the tariff cost on to consumers by raising prices. Could he have found a local supplier to avoid the tariff? That's the kind of risk mitigation action that becomes a Plan B. When the tariff policy evolves unpredictably, the situation demands a serious investment monitoring process and plenty of what-if scenario analysis. In this case, the market data source is the government, and that is much easier to grasp than situations where the source is the company itself. This page highlights management actions, often called corporate events, that can affect the stock price. To fully grasp internal and external contexts and make solid predictions, you must learn technical and fundamental analysis. Fundamental analysis requires some accounting and finance skills to analyze three key financial documents. The income statement is like a company's budget. It shows its income and its expenses. The balance sheet shows the assets a company owns, including cash, and the debt it contracted to finance the assets. The cash flow statement shows how cash moves in and out of a company, and whether the company generates enough cash to pay its bills and meet its financial obligations. Fundamental analysis helps you understand management's decisions and assess the company's financial health. Over time, this can help you make better predictions about the stock. The technical analysis studies price action and trading volume to identify trends, momentum, and patterns. It used charts to answer the question, what is the market telling us now? You must also pay attention to global capital flows. They can affect the business cycle, as investors move money toward countries with more attractive opportunities.
Thank you for noting that. I plan a phase of my due diligence activities within several countries in the emerging markets.
As you perform your in-depth analysis, consider how AI could affect the company's performance and its stock value, positively or negatively.
I see how I can use the AI penetration continuum and the market movers chart to assess AI's potential impact on a company's valuation. AI can influence a core indicator or an operational factor.
You sound like my financial advisor. I may hire you in a few years if you develop these important skills. Today, I can use a robo-advisor, but I'd still want to understand how its advice is made. Ideally, I'd like a partner who shares my goals and is rewarded when the results are successful. It could create a partnership where we share the rewards of good decisions and the impact of bad ones. If I win, you win. If I lose, you lose. Think about that.
This is the best session we had so far. I understand what it takes to think like an investor and operate like a CEO.
No panic. We will revisit the concepts I introduced today in future episodes.
Have a wonderful day. Thank you for sharing your knowledge with me.